Hi, I'm Ed Fulbright, CPA, CGMA, PFS, a Fulbright Financial Consulting PA. We would like to welcome you to our educational briefing.
Objective measures of the economy remain strong, but, as always, some signals of change are just ahead. Here are the facts. This index from the Institute of Supply Management, a trade association for purchasing managers, is a barometer of non-manufacturing business activity. Non-manufacturing accounts for 90% of jobs and 86% of America's gross domestic product. February's 57.6% reading, an upward move, is a positive signal. This index, also from the Institute of Supply Management, measures activity in the manufacturing sector, which accounts for 10% of jobs in the U.S. and 14% of U.S. economic activity. February's 57.7% reading is strong and extended a surge in manufacturing that began in September. Since this index was first tracked in 1989, it has not often reached this level. Both indexes are designed to dip below 50% before a recession. The non-manufacturing data series began in 2008, which is not a lot of history, but you can see that the manufacturing index dropped definitively before the last three economic downturns. A key forward-looking component of both indexes is new orders. New orders are actually a sub-index figured into both benchmarks, and this sub-index is a key gauge of what's about to happen in the economy. The new orders sub-indexes show business entering the pipeline of companies across the economy. At 65.1%, new orders in the manufacturing sector in February were as strong as they've been in years. Meanwhile, non-manufacturing new orders also remain strong at 61.2%. This signals strength in the economy in the weeks immediately ahead. Another signal of strength ahead is coming from consumers. Consumers represent 70% of U.S. economic activity, and their spending is driven by their income. Shown here are the 5 component parts of consumer income. Of the 5, the most influential component by far is employee compensation. The latest data shows that over the 12 months through January, employee compensation has been booming. In the last economic expansion, the 12-month growth rate in employee compensation peaked at 3%. At 4.4%, employee compensation is growing at a rate nearly 50% higher than at its peak rate during the last expansion. According to the latest data, consumer spending, which accounts for 70% of all economic activity and is a key factor in driving the economy's growth, is growing at a strong pace of 4.7%. Spending is driven by disposable personal income, what's left after taxes, and that too is accelerating by 4% in the most recent 12 months, yet another positive economic signal. Meanwhile, the personal savings rate at 5.5% shows Americans are saving at a much higher rate than in the decades before the Great Recession. Household balance sheets are in much better shape than they've been in many years. While all the data shows the economy is poised for continued growth, a couple of signals are changing, and one of them is the inflation rate. Shown here is the index of inflation used by the Federal Reserve to set economic policy, the personal consumption expense deflator. The Fed has long had a target of 2%, but the slow growth recovery since the Great Recession has occurred amid very low inflation. The latest data, however, shows inflation recently spiked up from 1.6% to 1.9%. With inflation data signaling change, Federal Reserve Chair Janet Yellen, in a speech on March 3rd, said the nation's central bank, barring any unexpected events in the economy, would raise rates in March and gradually shift from its accommodative policy that has helped keep interest rates low for a long time. Another signal that has seen big change recently is the stock market. Since the presidential election, the Standard & Poor's 500 stock index has soared by 12%. That's more than the 10% return historically averaged in a full calendar year. Stock prices have soared because economic signals are positive, but also because investors have begun to expect a tax break to be enacted by Congress. With political intrigue dominating headlines recently, however, progress toward enacting health care legislation and cutting taxes has been slower than expected and could be stalled. If politics gets in the way of cutting taxes and writing a new health care law, the stock market could be vulnerable. Major U.S. stock indexes are trading near all-time highs and could head higher still. Although near-term ups and downs in stock prices are unpredictable, the rapid advance makes it wise to expect a correction at any time. With fake news flourishing, our weekly reports are not intended as advice, but as a source of prudent analysis about news affecting your wealth over the long run. Please feel free to share them with your family and friends.
Thank you for listening. Please contact us with any questions, and also contact us if you're interested in our complimentary second opinion on your investments or to set up a meeting regarding your wealth. Don't hesitate to share this video with people who might benefit from our work. Thank you again, and have a great day.